Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three large cap stocks to consider buying now as we head into September and consider holding for a really long time. In those three names, we're looking at our Caterpillar, Walmart, and Visa. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into these three stocks, I quickly wanted to go over kind of the broader happenings of the market. I'm recording this as Powell is speaking in Jackson Hole. The big headline is saying, quote, we will proceed carefully on any further rate rises. So right now, the market's, the NASDAQ's up about 0.9%, so nearly 1%. After he's saying they're going to be cautious. So that's what everyone was hoping for, that he wasn't going to say anything really bearish or anything like that. So all eyes were on that speech. So that's why we saw kind of the sellers come back in yesterday in a big way on Thursday. But that came after a really strong start to the week. So it wasn't really a surprise to see people kind of quickly take some profits off after we had that nice jump back as the bulls tried to take us back up to that 50-day moving average. That's kind of the line in the sand people have been paying attention to, and there's no need to necessarily retake it in the near term. So it's not like a make or break stretch to close out August, but that's definitely a line in the sand that people are hoping the bulls can take us back above sooner than later. And it is worth noting that despite the selling, which has been substantial in August. August is historically a bad month for stocks over the last 30 years, and the downturn this time around was very much needed to help cool things off. So the bullish background still remains in the sense that the outlook for earnings in 2024 and 2025, and Wall Street's obviously always looking ahead, is really strong. Zacks estimates are calling for about 11.5% earnings growth next year, compared to about a 4% drop this year, and then another 11% earnings growth in 2025. And as we've kind of alluded to with Powell, the Fed, even if they have to keep their rates a little higher for longer than everyone would hope, they're certainly appear to be near the end of their tightening cycle. So those are kind of the bullish backdrops that helped drive the market higher. Those are still firmly in place. And longer term investors don't need to necessarily be worried about trying to time things exactly, since that's nearly impossible to do in real time. So in the selling has kind of cool things off enough to where it's worth maybe looking at some of these pullbacks. And the couple names we're looking at today, or the few names we're looking at today, are certainly worth as near-term and longer-term plays that you could probably consider putting in your portfolio and kind of not forget about, but not be too worried about investing them for, say, the next 10, 20 years maybe. And that is, as I mentioned, Caterpillar, Walmart, and Visa. So we're going to start with Caterpillar, which trades on the ticker CAT. CAT. It's that company you see, their giant yellow machines everywhere. They're kind of synonymous with construction in every corner of the U.S. They're plugged into various industries through mining equipment as well, and energy and transportation sectors. The company's able to also produce everything from marine diesel engines to gas generators. So lots of things they don't necessarily see on those construction sites as well. They're also focusing on kind of trying to roll out different businesses that help kind of shore up themselves during these economic cycles that they're more prone to. So stuff like IoT connected machines and things like that, more repairs and things that are going to slowly build a little bit of revenue when they have these cycles. But that's not going to be a big part of their business. So there's always going to be some ebbs and flows as Caterpillar has to deal with these large business cycles. But in the near term, they're definitely booming in the sense that they're going to benefit from a lot of U.S. infrastructure spending and reshoring. There's literally trillions of dollars going to be spent in the U.S. over the next decade plus on infrastructure and all of these things in the energy field that Caterpillar is going to be benefiting from. And in the near term, they're seeing a huge boom in construction. Their company topped our Q2 estimates in early August. They said their sales surged as construction is continuing to boom. Their energy and transportation segment was up 27% as demand rose for engines and turbines, and they expect demand to remain strong. And they see elevated U.S. spending on infrastructure specifically helping them out in both the near and long term. And its results come, as I said at the beginning, construction sector is booming. So despite kind of worries about high inflation and slower consumer spending, the construction sector is doing really well at the moment. And if we look ahead to our sales estimates, we're calling for another 12% revenue growth this year, and then another 3+% growth next year to get all the way up to about 68 billion. And this comes on top of 17% growth last year, then 22% growth the year before that. And then obviously they had a slowdown during COVID. And as I mentioned, Caterpillar does have these bigger ebbs and flows of these longer term business cycles, but the growth in the near term looks solid as well. And on the bottom line, we're calling for a whopping 42% adjusted earnings growth this year, and then another 7% on top of that. So continued growth on the top and bottom line, both this year and next. And since the company reported its results, its earnings outlook has really improved. So its consensus estimates up 10% for the current year, and then another 15% for next year. So really stellar outlook there. And then even if you look ahead to 2025, its estimates soaring. So things are trending up despite kind of the broader sense that the economy is cooling. Caterpillar is doing really well. So these positive earnings revisions help it grab a Zacks ranked number one strong buy at the moment. And its manufacturing, construction, and mining sector is in the top 2% of over 250 Zacks industries. So that shows just how strong the business is doing at the moment. And then in terms of dividend, you get a yield of about 1.9% at the moment with a really stable payout ratio of about 26%. And that yield tops its industry's average of about 1.5%. And then in terms of, we're going to end with just some price and valuation stuff, because this is where Caterpillar is looking really strong as well. Caterpillar shares are up nearly 1,200% in the last 25 years. This is versus the S&P 500, it's 450%. And that does include some larger swings, given its exposure to those cycles, with a total return, though, which factors in dividend reinvestment of about 2,300% versus 830% for the S&P 500. And then Caterpillar stock has climbed about 90% in the last 5 years versus the benchmark's 53% and 40% in the last 12 months, including a really big surge since early June. It is down around 8% from its highs that it hit right around its earnings release. So it's cooled off a bit. So it's a nice entry point, and it's trading still above its 50-day and 200-day moving average. And it's also now around neutral RSI level. So that's a good sign after climbing way above overbought. And then in terms of valuation, it's trading 60% below its peaks, even though it's only trading 8% below its highs in terms of price, and nearly 20% under its median, and 30% below the S&P 500, despite that long-term outperformance. And this is at 13.4 times forward earnings. So getting some really strong value for Caterpillar as well. And it's trading at a 15% discount to the Zacks industrial sector. So it certainly should be a name you consider as a way to gain exposure to overall construction and industrial sector growth in the U.S. economy and kind of around the world for both the near term and long term. And now we're going to move on to Walmart, which trades in the ticker WMT. The stock has hit new highs at various points in 2023, even as Target and others in the retail business have struggled. The company posted blowout Q1 results in May, and then it topped our Q2 estimates on August 17th. And it boosted its sales outlook as it sees consumers looking for more deals, and this is across all kind of income levels. So they're benefiting from people kind of returning to normal and not spending on all of these lavish COVID things. They're not buying refrigerators and deck chairs, but they're buying normal things while also spending still on various other things in the economy like traveling. So they're just getting back to their normal lives, and Walmart's really benefiting from that. But before we get into some more near-term outlook, let's quickly just kind of go into how they're adapting for the future. So like everyone, Walmart is offering everything from delivery and pickup, as many delivery and pickup options as possible. They've pushed further to compete against Target and Amazon by having their subscription service, which is called Walmart Plus. They also focus on various partnerships with popular digital native retailers and bringing more businesses to their own third-party marketplace, which is kind of going to be a key little side business for them going forward. And on top of that, the company is growing its advertising segment as more and more shoppers are starting their searches on Walmart.com. So kind of like Amazon has a big advertising business, Walmart.com is having a big booming business as well. So the company's U.S. comps jumped about 6.6% last year and up 13% on a 2-year stack, with its e-commerce segment up 12% and 23% on a 2-year stack. So doing really big business. Overall, it's doubled its e-commerce business over the last 3 years, and it's continuing to innovate and focus on automation, and this is in its warehouses and stores and beyond. So all of this is going to help it compete against that other giant nipping at its heels, and that is Amazon. So Walmart's certainly not just sticking to its regular business as usual. It's going all in on the future as well. And the company is just a massive, massive firm. It's pulled in $611 billion in revenue last year, which was its fiscal 2023, to blow away Amazon at 514, Apple at just below 400, and ExxonMobil at about 415. So still just a massive company, the biggest in the world. And looking ahead, it's seen its earnings estimates jump since its last release. So its current year estimates are up another 4%, and next year up another 2% since its last release. And this is part of a longer-term upward revision trends that help it land a Zacks rank number 2 buy at the moment. And looking ahead, Zacks estimates are calling for Walmart's U.S. comps to jump about 4% in 2024. So that's their current year. And the company's overall revenue is projected to climb roughly 5% higher both this year, or 5% higher this year, and then another 4% higher next year, to get up to about $664 billion. Walmart's adjusted earnings are then projected to climb about 2% this year and then surge 9% higher next year. And it boasts an impressive history of bottom line beats, including a 12% average beat in the trailing 4 quarters. And then in terms of its stock and valuation, we're going to close out with there. So the stock's up about 65% in the last 5 years. This is versus the S&P 500's 53%, Target's 43%, and Amazon's 36%. It's also crushed its rival Target over the last year plus and climbed to new highs at various points because, as I kind of mentioned, consumers are far more focused on the essentials again, which are in vogue after that COVID spending boom, and essentials are never going out of style. The company is also currently trading 13% below its average Zacks price target, which is great to see. And it sits at about a 14% discount to its own 10-year highs at 23.2 times forward 12-month earnings. And on top of that, Walmart recently broke above its previous 2022 highs, which is a possibly bullish signal. That said, it is back below those levels, so we're going to need to see it climb back above there soon enough, but it's a good sign to see it finally break above there. And it's currently floating around its 50-day moving average after that healthy pullback. And then overall, 21 of the 30 brokerage recommendations Zacks has are strong buys, next to 4 buys, and it has no holds at the moment. So Walmart's hardly a flashy stock, as you know, but it's useful to have as a part of a diversified portfolio, kind of like with Caterpillar. It's certainly not a sexy growth name, but those go a long way over the long haul. So certainly worth considering Walmart amid the high inflation that's still going on and still having consumers look to spend on essentials, and Walmart is the home for everything essential. So certainly worth considering Walmart as a longer term play. And now we're going to close out with Visa, which is trades on the ticker V, and it's a credit card giant that remains hugely influential in the U.S. and around the world despite all these quote unquote disruptions from fintech. It operates an extensive and powerful payment and processing network, and it takes pieces of those endless amounts of credit card payments and swipes that are happening every day in our increasingly cashless society. The company's earnings and revenues then beat our estimates in late July. In looking ahead, Zacks estimates are calling for Visa's revenue to grow another 11% this year and then another 10% next year to get up to about $36 billion. And then the bottom line, we're calling for 15% adjusted earnings growth this year and another 13% next year. And this top line growth would come on top of 22% growth last year, 10% growth the year before that. A little hiccup during COVID, but this is a company that just produces really consistent top line growth for obvious reasons. Everyone is spending money on credit cards. The company currently lands a Zacks rank number 3 hold, but it has seen its earnings revisions trend slightly higher. And Walmart's really high, or excuse me, Wall Street's really high on Visa stock at the moment, with 17 of the 22 brokerage recommendations that we have coming in as strong buys, next to 3 buys and 2 holds. The company is currently trading 10% below its average Zacks price target as well, and it pays a dividend. It's yielding about 0.75%, so 0.8% at the moment, with a really stable payout ratio of about just 22%. And then in terms of its price performance over the last 15 years, it's up over 1,100%. This is versus the Zacks tech sector's 330%, so just a massive outperformance. Though it has come back to earth a little bit over the last 5 years, it's up 65% versus tech 72%, so lagging that sector. And then if we look over the last year, it's up about 18% versus tech 16%. So outperformance there, and it's kind of chopped around. So it's currently trading above its 50-day and 200-day moving averages, but about 3% below its highs. So we're hoping to see a breakout sooner than later. It's trading at, though, in terms of valuation, trading at a 35% discount to its highs at 24.8 times forward 12-month earnings and below its 10-year median. So that's a great sign, even though it's not trading that far off of its peaks in terms of price, and it's sitting at neutral RSI level. So certainly worth considering Visa at these levels for, despite all of the, as I said, the fintech quote unquote disruptions, Visa and its fellow credit card giant MasterCard are still really great long-term plays. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.